Good morning, everybody. Welcome to the Flow Show. We've got a jobs field day today with the ADP dropping. Give everyone a little bit of a nudge before the NFP. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. Oh, let me kill the squawk. Good morning, Ryan. Good morning, everybody. Yep, all good. Well, I'm feeling slightly under the weather since yesterday afternoon. I don't know why, but okay, holding up. Let's hope it's
good. Hope you're not coming down the old lurgy, mate.
And,
not
no,
very
after
nice.
this morning, nothing showing.
Yeah, well, I hope it stays that way, mate.
Hmm.
It's the time for all the funny colds and coughs and splutters. So,
Just
yeah, keep yourself wrapped up nice and warm.
that, I guess. Yeah.
Yeah. Cool. Right, let's get stuck into it. Over in China, they set the midpoint at 711, so keeping that down there. Now, for the second day running, they've been intervening or getting their major state-owned banks selling dollars against the yuan on onshore markets yesterday. I'm coming a bit to the conclusion that there's still a fair bit of pressure on weakening the yuan over there, hence why they're firefighting down at these levels. We've obviously had that big move and they were firefighting up here. So you would perhaps expect them to maybe take their foot off the gas in terms of getting their banks to intervene, but it seems not. So they seem very reluctant to let this get back up to those levels. So as I say, second day running, they've had their banks intervening on that. So that, again, as I said, suggests that there is some pressure for people to sell the yuan based on everything going on over there. It also means if we do get some worse data from those guys, I think we've got CPI coming up this weekend over there. There is going to be a hell of a lot of pressure. They might have to open up the hoses a bit more if they're going to stop this one going up, if those numbers continue to show a deflationary slant to things. So yeah, they're keeping they want to keep this lockdown here and keep the pressure on. Not throwing any kitchen sinks at it just yet, because if they wanted to, they could send it sub 7 if they really wanted to throw the cat at it, but they're not doing that now, so it's merely a smoothing operation. But as I say, suggests some pressure there. S&P and Fitch decided not to follow Moody's lead and get on China's bad side. They issued ratings or updated ratings for China, both of them, reaffirming China's credit rating and keeping their outlook as stable. So Moody's downgraded their outlook to negative. These two guys are keeping them as stable. So they're in the good books as far as Chinese authorities are concerned. We've had Deputy Governor Jimeno of the BOJ coming out saying that they will continue with easing patiently until the price goal is in sight. They don't have a preset schedule in mind on the exit from easy policy. It says Japan is seeing steady changes in price and wage behaviour, and says that Japan's financial system is likely resilient enough to weather the stress from transition to higher interest rates. Japan's regional banks have been out again, this time speaking to or statementing to UEDA to scrap negative interest rates. That's according to executives when they met UEDA last month, according to people familiar with the matter, the old sources story there. As Kay mentioned in the chat room, not the first time these regional banks have called on the central bank to scrap negative rates. We'll see whether they get their wish in the new year. Japan, the government is also it's showing how much it's pushing for these wage hikes because it's thinking about a tax carryover for any loss-making small or medium businesses who input wage hikes. That's according to Kyoto. So offering incentives now to brush off the cost that's associated with wage hikes. They really want these wage hikes to come next year. They see it pretty much as their sole way out of easing monetary policy and turning the economy around into a growth and higher wage economy. What did you make of all that, Kay? Himino pretty much repeating the lines from Ueda. And
Yes, but then he did say that they're clearly good signs. Yeah, I mean, the rest, yes, as I was saying in the room, that's already years that the regional banks are suffering because of negative interest rates, because they they really need income from loans, etc., to survive, basically. But the issue now with the sole responsibility of seemingly the sole responsibility of moving out of negative territory, or changing monetary policy for good, is the wages, and that somewhere may have a small negative tone, because that means that all those stimulus packages that the government has been throwing at the economy for the past decade or longer, really, especially accelerated over the pandemic, after a first big leg after the big earthquake, hasn't helped much. So the responsibility comes to apparently the companies themselves to decide upon. They will make the decision that the Bank of Japan is going to move out of negative rates or not. It's a bit strange. Yeah, I was saying in the room, I mean, a few weeks, months back, any of those hints at saying like, okay, he's better than. We also had this study report out saying that since they changed the YCC, the bond market has been functioning better. So that's another hint that perhaps they will continue to loosening it a bit more. Although if we look at the Japanese JGB yields, we're nowhere near the 1% top end of the band. But yeah, I mean, a few weeks, months back, that would have sent the yen probably a leg higher, but the market is getting very tired of all of it. And, I mean, probably tired as well of fighting the carry, because if you see those dips in dollar yen and then they get undone. Yes, I mean, the yen crosses are trading lower, but they always seem to want to come back at some stage. So it's really going to be it's going to need the Bank of Japan to really change tactics, to really go heavier into changing monetary policy, to get the yen to rally more lastingly. Yeah, we've seen, of course, the yen strengthen a bit because the rest of the world yields were coming off. Like I said many times, I mean, that is going to be the first condition for yen to strengthen is the rest of the world coming off, and that's what's been happening. Now we are, I guess, back at a stage where the rest has come off. Not sure whether it's going to last for much longer, or whether those yield moves will go much deeper. I think we have done the bulk of the swing of the pendulum, and yeah, for the yen, I think it's back over to the Bank of Japan. I don't know if they can do anything in, what is it, 2 weeks time from now. Nobody is expecting it. They have surprised the markets in the past, but I don't see how they would this time.
do you think that Japan's putting a lot of eggs in one basket, relying on these wage hikes next year?
Well, I mean, yes, because remember what we talked about, and that is then the issue that they have now. When the other central banks were hiking massively, 2020 it started to filter through around mid 2021, and then started to really ramp them higher in 2022. We said it, and I said it many times. The window is wide open for them to change now, without even having something. But now we're seeing the rest of the world starting to slow down, yields coming down, and everything. And the Bank of Japan still hasn't done anything else than just psychologically widen the YCC. And I think the window of opportunity is fast closing. And imagine that 2024 is a year where we see that global slowdown, which was expected for 2023, but perhaps we're going to get it in 2024. But imagine that we are going to get that slowdown. How is this window going to be come the end of the fiscal year in Japan, end of March, and the start of the new one, where really they're expecting to really move things after the spring wage negotiations? That's another 3-4 months from now. Time lost, you know.
Yeah, yeah. It's
So
just
the opportunities
it
become
feels a bit
less and less.
unusual that they're putting so much weight on these wages. They they don't tend to pigeonhole one thing as their sole reason to change things. Obviously, getting out the deflationary spiral was the original job. It just I don't know. I mean, I'm just wondering if obviously if these wage gains don't happen, they're in the shit big time, and so will
Oh
the
yeah.
MB. But I'm just wondering, is it if the government's pushing that hard, are firms just going to hike wages just to go along with the government, or will there be some pushback if they haven't got the profits there to do
Well,
so?
it's Japan, there's always a possibility that the companies go yes sir and or yes prime minister and just hike those wages.
Consumer says jump, and firms say how high.
Yeah, the thing is, the exporters at least have had very good years, so um, they can go for it. The other side of the medal is less clear. The importers have been, even though energy prices have come down, but the importers have, as it is in Japan compared to anywhere else. Yes, we had the CPI above 3-4%, but they never had like any hikes of 5-6%. And some of those CPI hikes as well, we need to know, is just because some rules and regulations of price caps have been taken away. So it's just price caps being taken away, not like real hike. And it's always a very difficult thing in Japan to full pass on full price hikes because of the economy being not like overly dynamic, right? So that
Yeah,
are the other side, the importers going to be able to raise rates as much or wages as much? I don't know really. We could end up being like promises from one side and less from the other, and then an average, which is perhaps going to come out right around the CPI. So real wages being relatively flat still. So, but let's also not forget that the Bank of Japan is pretty slow because they know that the government has to finance a lot of those stimulus packages, and behind the scenes, I'm pretty sure that that plays a role as well in them being so slow. So I'm still thinking that 2024 will be very interesting. But again, if we see, as you say, a bit of a disappointment on those wages, the real wages we have to look at, right? Because
yeah,
it's good and well to give your employees 3%, but if your CPI is at 3.5%, their real wage is still going down, right?
yeah, exactly. It's going to be fun in 2024 on that front, most definitely. Right, let's move on. Have a quick look at some of the data. We had Aussie GDP out overnight. Not looking overly great. A positive number, but missing expectations. Quarter on quarter, 0.2% versus 0.4% expected and prior. Although the year-on-year number was higher than expected. As you can see, some of the details there. CapEx was up, but a little bit softer. One of the price indices was up 0.6% versus minus 2.2 prior. Consumption a little bit better than expected. That was a final number there. So Australia is another economy where it's just banging along near that zero line, like a lot of economies are at the moment. Further on from that, we had some factory orders, which actually took an absolute bath in Germany, down 3.7%. This may be a bit of a lag because we have seen the PMIs showing a bit of improvement, and that's obviously those are obviously for November, whereas these factory orders are for October, where things were looking a bit crappy. or crappier back then in the PMIs. So maybe the November numbers will show a little bit of an improvement there as well. We've had some construction PMIs out, not a huge mover for the euro, but keeping an eye on it anyway. Italy doing well there, further into expansion. Germany, here we go again, further into contraction, 36.2. France showing a little bit of an improvement there, still in negative though, and the pan-Eurozone number a little bit of an improvement also. UK numbers there as well, a pip worse than they were last month. Was expected to rise a bit, but didn't. Greece GDP, I thought these guys were doing pretty well, but they've come in with flat GDP quarter on quarter, and a little bit worse than last quarter, 2.1% on that. Eurozone retail sales out, nothing to write home about, a little bit softer, 0.1 to 0.2. You're arguing over a pip there on pretty flattish numbers. Anyway, year on year, a little bit softer than expected. Again, this is for October, so we get to see whether the holiday season, November, December period, show any signs of life for the consumer over there. Over to the ECB. Steve says Steve didn't buy enough boats for Greece. Yeah, both Steve and Stel, cutting down on their boat supply. I don't know where they keep them all. Right, ECB's Wojcik says the baseline scenario sees no more rate hikes and rate cuts are not expected in the short term. Now, one of the hawks, ECB's Kazakh, says there's currently no need to cut rates in the first half of 2024, but then threw in quite a significant caveat, saying that but if the situation changes, our decisions might change. So it was definitely a bit of this is another hawk who's, I wouldn't say falling out the nest, but is starting to put some excuses in for their hawkishness and possible changes of sentiment there. On the rate expectation front, according to Bloomberg, traders now see the ECB cutting rates by 150 points through 2024. As you can see, we're really ramping up the rate cut expectations. Sorry?
I'm negative. I'm going for ECB rates going back to minus 0.5% by May 2024. or can they even do it back value? I don't know, asking for a friend. Come on. I mean, it's getting a bit
starting in June.
it's getting.
They can announce the end of PEP reinvestments at this meeting to start in 2024, and then by June they'll be doing QE again. So
yeah, but it's that shows all our listeners. We've been talking about that many times, how the market can swing. But then it's also the journalists making up, like they're pricing in this and that. There's stuff in the bond markets that we just those flows have to be done, and that shows you something in the yields. And then people say like we expect as many rate cuts, and we have to take it with a little bit of a grain of salt, right? Once it's going to, let's say, normalize, or the pendulum coming back a little bit more to the middle, perhaps we are going to go back towards. It's possible to do 100 BP cuts, but like pricing it in from near zero a month and a half ago, then to now pricing in 150 BPs just because your what is it, your some stuff has changed in the PMIs or things, or 0.2 added on the labor in the labor unemployment rate is not going to cause 150 BP rate cuts, right?
Yeah, exactly. We said this earlier this year, coming out of summer, when we play the rate cut game, you're going to have the market going far too extreme, as it often does, particularly on the dovish side. And we're heading that way. If we start seeing pricing coming in at 200 pips a cut by, first 3 quarters of the year for any bank, then we're going to be pushing into well overdone territory. But I mean, the markets aren't actually moving in line with those extreme cut expectations yet. If you start seeing the euro back down, 105 or more, because the market thinks ECB is going to cut by 200 pips. That's when you're starting to get into the extreme territory. That's when you'll start to get the stronger pushbacks and the potential trades to fade that the other way. But as I say, not seeing anything that suggests to me we're going too far in real pricing compared to what the market's saying. But anyway, I digress. Looking at some of the data over in the US from yesterday, we had a few bits and pieces out over there, obviously the ISM being the main take. First of all, we had the S&P Global final number from the US for services, 50.8, so matching the flash number and confirming the tick up, or a couple of ticks up over the month before. Canada as well, they had their services PMI that went a bit worse, 44.5 versus 46.6 previously, so not good for those. Then we had the ISM coming out, which was pretty decent. It was okay. The numbers were a bit mixed within it. We had employment missing expectations by a chunk, but still going up over last month, just to say not as high as expected. New orders, they matched the prior month, was expected to dip back a bit. 50 numbers on all of these. So it's looking good, the headline number going up. Prices paid, that dipped a little bit, but still looking a bit sticky. Only a 3 pip drop over last month. So nothing for anyone to get worried about in the services sector, and certainly that all looks like soft landing numbers. Where we did get the moves and the market reaction was on the JOLTS, with job openings falling by a good chunk to 8.7 million from 9.3 million expected. So the market had a little bit of a, what's going on here, as job openings come down. Now, job openings, these are like vacancies. So a falling amount of vacancies can signal two things. One, that there's no people looking for jobs, so it's no point in advertising. Two, it's firms who maybe are finding things a little bit tougher and therefore cannot afford to employ people. Now, within this, we've had loads of different excuses as to why it was so high. We've had the excuse that there was a lot of phantom job openings in this, whatever you want to take for it. It is something that the Fed look at. So maybe this is something they will touch upon at the next FOMC. It also needs to be noted that this is October data. Okay, we're just about to get the November NFP, so we're already over that hump as far as the NFP goes, and we've not seen anything untoward there. Not that there's a direct correlation, but if you take one trend with another, that sort of thing. So anyway, the market's going to look at the JOLTS number. It reacted to the JOLTS number. The Fed may say something on it. We'll see if this continues to go, and if we get a bit of insight as to why these job openings are dropping. What did you make of all that data yesterday, mate?
Okay, so as you were saying, first of all, we were talking about that, right? To keep an eye on those employment numbers. So it's still above 50 in the ISM. So that is still okay. And since it's a November number, as you rightly say, compared to the JOLTS, which were an October number, those JOLTS numbers, wasn't it like somewhere a little bit as expected, because we've already seen hints here and there that people, well, the hiring gets a little bit easier, or they don't need as many people anymore. And I looked at some of the details. It's pretty much globally. There's quite a big chunk of the slowdown, let's say, the negativity in the number is in the financial markets. Which is also a bit likely to explain you can't just continue to hire. And we had those throughout the year. We had those issues with the medium size or local banks, regional banks as well. So there's a bit of normality creeping back in, but perhaps into those numbers, which were very, very high for a couple of years. Okay, as you can, as Ryan is showing there. We are not back yet to numbers in 2019, but we are getting closer. Okay, so I wouldn't say anything majorly alarming, but we have to note the slowdown, which is a slowdown like we are seeing globally in most of the major economies, right?
Yeah, very much
That's
so.
really,
And even at these numbers, you can see from the longer term charts, it's still pretty strong.
yeah, exactly.
But it's not going to stop the market making, taking conclusions from that, making conclusions for that in terms of jobs. And it's saying we need to keep an eye on. If it starts getting down to 6-5 million job openings, then maybe that is starting to flag
Oh,
something. But
yeah, I bet you that if it drops below what is it, those 2019s, they're seven and a
yeah,
half or
remember that, yeah.
something of the likes. Yeah, then the doomsayers will get very quickly to their panic stations.
Yeah, exactly. We shall see if that happens. Right. US Treasury Secretary Yellen out with some kiss of death comments overnight. So if you're wondering if the jobs market's about to collapse, Yellen might have given it the psychological nudge. She says soft landing skeptics are now eating their words. Growth will come down, but we're not seeing weakness on the spending side of the economy. We're not seeing the usual signs of a weakening labour market that would bring fears of a recession. So she's giving it to the people, to the US bears over there, that they're not seeing the collapse that was expected. As I say, if that's not a big kiss of death statement in that one, I don't know what is. That probably means we'll see NFP coming in minus 200k now. She said that. Don't be surprised how things like that work out. But anyway, she's pretty bullish and doing a bit of pushback against the bears, as I say. On the energy front, Russia's Deputy PM Novak was weighing in on the OPEC stuff, saying that OPEC plus countries are ready to strengthen oil production cuts in Q1 2024 to eliminate speculation and volatility. All well and good for him to say that. He may be adhering to OPEC plus cuts. He's still selling oil out the back door to China and India and everyone else who'll happily take it off his hands, or off their hands. Putin is going over to meet the Saudis for chats, or the OPEC lot for chats, just to reaffirm his support for that lot over there. That's it on the headline front. Kay, anything you want to bring to our attention?
No, that's fine, mate. I think we covered a lot. No, it's fine. There was a bit of, well, I mean, again, an article about QT, the RRP reserves starting to come down. So get another week of that, and perhaps the panickers will start to call about a possible dollar liquidity issue, but that's all like still very, very light for the time being. No, for the rest, I think you covered absolutely everything. Just perhaps we look a little bit ahead to what's happening later on the Bank of Canada.
Yeah. Oh, yeah. We've got the Bank of Canada today as well.
By the way,
yeah.
You were talking about the NFPs on Friday. I've posted the link for the NFP comp in our chat, show chat. So for everybody who wants to try and win access for a while to our community, get your guesses in there.
Yeah, thank you very much, mate. As Kay says, that link is in the chat function here on Zoom. Right, let's take a look at what's going on. So yeah, we got the BOC coming up. I think it's going to be a bit RBA-ish, maybe not in price moves, but in terms of sentiment, I'm expecting a bit of a flat one from those guys. They won't shut the door on hikes, I don't think, just yet, but they're going to keep the message probably fence sitting, let's call it that way, on the tightrope. They may do more, they may be in a good place now, so on and so forth. They're going to be watching the risks, what's happening in inflation, blah, 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 blah. I don't think we get a presser with this one. It's just going to be a straight announcement, I believe, because we had the last one was a presser, wasn't it? Or the one before, I can't remember.
Yeah, the last one, there was a press conference. I'm just going to quickly check on their their webpage while you are talking about it.
Yeah. So rates expected to stay unchanged at 5% over there. The CAD will obviously potentially move, depending on what comes out in the statement. So a pretty neutral can kick to next year. Thank you very much. Happy Christmas. Probably won't see an awful lot happening. But as we've seen, we can move if they're a little bit dovish in the market's eyes. If another hike is further off the table or further away on the table than it was before, then we're probably going to see dollar CAD rising or CAD getting sold off anyway. But if it is a little bit hawkish, we might get a little move back down to this support zone down here, 135s into the high 134s. So that might be a bit of a area I'll keep an eye on, depending on what the dollar's doing itself going into that number. We're looking a little bit bullish on the dollar right now as we sit here today. So it might be one to look at for the BOC just to see if it knocks it out of trend with the rest of what the dollars are doing. So, for example, if the dollar's looking pretty strong across the board, the BOC is a little bit hawkish, then any dip in dollar CAD might be a little bit of a good counter trade to take up for reversal back to the trend. Kay, you got any thoughts for the BOC?
Yeah,
I feel like I'm really excited about, does it?
Yeah, so indeed, I went onto the website, nothing before tomorrow afternoon, where Gravel, the deputy governor will talk, and then Stiefers is not expected before the 15th, actually. So on their website anyway. So it's going to be just season's greetings from him next week, I guess. So yeah, neutral. People say that they can do a hawkish hawk. I think it's going to be a very neutral report, this one. Get back to the middle zone, as we've already been saying. Oh, sorry. Yeah, that's my main thing. Dollar CAD could be in a range there, and depending on what the rest of the dollars will do. There's one that I'm keeping an eye on, which is Euro CAD, because of the euro still being a bit weak. It hasn't really bounced a lot despite much lower oil prices and stuff. That one may be, if we get a little more of a hawkish slant to the meeting, that could continue to be weighed down. I was saying that give me a small dovish read, and perhaps somewhere between 147 and a quarter, 147 and a half. I could be interested in that one for a little counter trade perhaps. But really, yes, I mean, I'm expecting a neutral one today.
Yeah, and Horatio, looking at pound CAD, which I just had on the screen there. Yeah, you're going to look for the same things in any of these CAD pairs, really. Just as I say, bear in mind what's happening on the other side of the CAD. So if you're looking at pound CAD, we know that the pound is a little bit more resolute than some of the others at the moment. It's holding up a bit better. So factor that in. Maybe a dip in on a hawkish message in pound CAD might be a better look for a fade than dollar CAD or something else. So yeah, just know what the other side of the pair is doing, strength, weakness, when you look to trade this stuff. But yeah, it's a usual thing where if it's not a monetary policy report meeting, i.e. a press conference, they always tend to send someone out the day after just to have a chat with markets and explain away the latest situation there. Ali, haven't forgotten about you. Your short cable, 1 in 26.01. Let's have a quick look at the old cable. Yeah, as mentioned, just hold it up a bit better. Not really getting under this 126 and holding just yet. So it's pretty much holding. We had a little dip yesterday, but it's back there or thereabouts again. So, it needs to resolve under this area. It needs to see a decent hold under this, call it 126, and this fib level as well. We seem to be finding a bit of support this morning. So clear this, start holding under that, then you're going to see some downside. I'm not suggesting this is going to rocket back up, but it just seems to be going down a lot slower than some of the other dollar pairs there. So good luck with your trade. Sensible stops and take profit. Yeah, we won 26.40s right in the middle of this lot here. So again, maybe have a think about that. Just are you in the middle of a traffic zone? Would you rather be clear of it? Euro sterling, that's putting in a bit of a fight down at this 85.50. But as you can see, the bounces thus far are pretty weak. We're in a bit of no man's land around here. Until we get back above 86.10, then the bearish pressure is going to remain on this. But I'm thinking this 85.50 is building up to be a bit of a trapdoor for a move down to 85. So if that holds for a bit longer, we find that we're building a bit of support there. May mean we get a push back up, but if we can't get over here, I reckon we're coming back down, and a break thereafter will probably do a bit of damage. As I say, will at least carry us down to the low 85s on that one. I'm still interested in adding back into my longs down into the 85 zone, but I'm going to be very, very careful on the price action of this one because the bearish pressure does remain in place and it's quite strong. Although potentially I'm seeing 85 as a bit of a stretch point. Just going to have a quick look at oil. I'm keeping an eye on Brent because I'm still in a short in this one. We have nicked under the November low, if only by a few pips, but it's significant enough. The 79 level is now holding better as resistance than it had done in this moves here. We could be on course for a trip down to the low 71s and all these lows down here. WTI is obviously going the same way. It's had a little bit of a break of my zone here, 72, 73s, and that break is now firming up. We're finding resistance into that area. So the first line to look at is the 70 buck mark, which is everyone's favorite number for Bidden to come in with his bids to replenish the SPR. Failing that there, then we're also heading towards the big low points that we've seen. It's a little bit more messy down here in WTI. We've had previous breaks below that area, but this after that, this is where the market tended to hold up around the 67, 68 area. So that'll be the natural point to look at if we do break under. Doesn't matter what OPEC's saying at the moment. The market's saying, no, we're not having it. Doesn't matter. You can extend cuts. You can do whatever. For now, we don't believe that this is going to help oil one little bit. And so the bearish pressure is on. But obviously, get down to these lows, then there's questions going to be asked. Lastly, before I hand it over to the K-Man, a quick look at yields because it's now really starting to carve through the levels. It's doing a good stepping job. We had the 450 was our support point. We had the break, its resistance. Next level, 430s. We had the break, its resistance. Bounced off the next level, 420s. We've had the break, two breaks, its resistance. So there's no let up in this one. But I think we are, right, 10-year yields is one thing. 2-year yields is holding up a little bit better. I think if these really start to come off, that'll show that we're really ramping up cut expectations, and it's probably the shorter end you want to look at. Just if those expectations or if those yields get really down low, then that's going to reflect the market, as I say, getting out its pram over rate expectations. But the 10-year, it's still going one way at the moment. Bit of a surprise today, Kay, that yields are looking off in the US, but the dollar's looking stronger.
Yeah, because the rest has come off around it. That's always the thing. If you look at the differentials, as I was saying yesterday, we're back somewhere close to the edge of the lower edge of the box, and euro dollar has suffered a little bit. The rest of the dollars has followed suit. If you look across the yield spectrum, all those yields have been coming off. So it's not only the dollar yields that they let's say they run faster or front run everything else, and then we have seen this happen time and time again, is that the rest is catching up. So we're still, if you, it's still one big pot of net, it's still one big pot, and the rest of the yields has been coming off around it as well, because we see, after all, pretty similar data all across the globe as well, in a bit different speeds, one moving a bit faster than the other, but yeah, it's basically still one big trade, right? I can show those EU yield differentials where we're back at a little bit of the edge of the box, and which is also going to be interesting for what's happening in the euro dollar in the next couple of days, I reckon.
Yeah, just before I do that, is it significant that we're seeing, the short end of the European bonds, quite significantly below, the current ECB rate? I know it's not a linear correlation, but
Yeah.
some of the big countries, France, Germany, well below the current ECB rate. It's almost as if these yields never, got up even towards, where the ECB rate was compared to like the US short end, where
Yeah,
it got up into the
absolutely.
5%.
Yeah, that also shows that that the situation, well, I mean, the situation in Europe has been fragile, and as we were as I was telling the other day about GDP and even inflation moving, actually where Europe is usually a slower continent, the old continent, a slower mover. They're actually moving faster than what's going on in the US, which usually is your more dynamic economy compared to Europe. But this time, yeah, I mean, everything is moving together, and Europe is feeling a bit more fragile as well, and which explains that those euro crosses have been coming off as well, and euro dollar from the highs relatively swiftly. But yeah, we have to. They have been moving quite a bit indeed. Yeah.
Yeah, thanks, mate. Right, let's kick the can over to you. And while you're just grabbing that, Ali's asking about moving averages. I've learned in trendy market just to use.
There's down
Sorry.
to anyone really. Whatever fits your bill, or that's. I think
Yeah,
it's very
moving
personal.
averages. It also depends on the volatility as well. Moving averages can work pretty well, like you say, in trending markets, in calmer markets, more so than volatile markets. But it's like anything else. I'm not a big man for stochastics, RSI, that sort of stuff. I like a moving average. I look at it for it's just parcel of what's going on. If it's working, it looks like it's working, then you use it. If it's not, you don't. Or if there's confluence, if a moving average matches a fib level or a trend line or whatever, the more tech you have at one level, close to one level, then gives you a bit more confidence to trade something. But whatever floats your boat, Ellie. Over to you, Kay.
Yeah, thanks. And I also would like to stress that moving averages, well, in my opinion at least, are good for the longer time frames. You don't start to move around. Oh, well, I mean, personally, I don't do anyway around like anything shorter than the 4 hour for me, personally. I have them on my screens just to keep an eye on, because I know a lot of people are watching them. Yeah, I know, Brandon, it's your thing. But if you look at it, like for instance, I mean, okay, this is only like the differentials, right? So I should really take them off because they don't have much to do here. But I was just showing the box here. This is what happened. This is really your 110 down to where we are now in the euro dollar. We're hanging on the edge of the box, and there may be a bit of activity here around this trend line as well, which comes in around the lows that we've seen the deepest somewhere in August. And then if we would widen even further, then this big zone will come into play. Now, taking a look at the euro dollar, I voluntarily did it like quite on the daily, because I'm going to overlay the make it even more spaghetti like, and overlay the cloud in a minute. But this is the zone here that I'm looking for. So people know I've been short, I've been managing it. I took some more back this morning because we are entering the zone. So on the daily, for instance, we've got the 100 DMA, which comes in at 107.70. And then we have the 50% of what's been going on since October into the end of November, when we hit the highs, comes in at 107, around the 35 zone. And there's a bit more activity here as well. If you look at the bigger decline from 112 down, we are slowly getting back to the 107.65. So this whole zone to me is going to be a bit of a decision zone. We can also see it here. We had a stop in the 107.5s before going back down to 106s, before then ramping up finally to 110. So to me, this is a quite important zone. And as I was looking for a setback, but I'm not so sure on what's going to happen on the differentials. Like for instance, those yield differentials can stop going down, and I don't know what's going to happen on the US data. I am more than happy to leg out of what I have now and reassess. You know, I'm not per se going to get bullish on the euro dollar, because I'm actually not bullish on the euro, but it could be enough. That's just what I'm saying. Okay. And actually, on my leftover, I really tightened the leash now, because I think if we start to get back above this 108 figure 15, call it, or figure 20, it's likely that the party may be over, and we're going to have a look higher. Now, be careful, because this is going to hurt your eyes. We're also trading around the daily cloud. Well, we're entering the zone of the daily cloud baseline. Okay. If you're short, or if you're looking for where the next support may lie, if we get through the 107.35.65 on the euro dollar, the next comes in around here. Then you're talking about the 55 DMA 106.85, and the cloud, which comes in today at around, give and take, 106.95, 107 the figure. Okay, so this is your next zone. And then you're talking about the next support just around 106.60, 70, where we remember we had been trading around there a couple of times as well. So that for the euro, I think that if this is just a correction, we are going to at least find some take profit buyers around here lightly. And if we get anything bad on the US numbers, this can be the zone that is starting to hold up the euro dollar, right? This is so how I look at things going into the rest of the week, basically. I just want to come back quickly on that cable, because I have an additional line there. So depending on what you this is also your November move, right? But depending whether you take it from this really end of October, the ramp higher in November, or you take it from the actual low, the 23.6 comes in either around 125.68 or 125.75. So that back onto what Ali was talking about on his cable, I think this is this could be a level of interest. Look where we stopped yesterday, Ali. Yesterday evening, just around that line there, 125.75. That is something that you may want to keep an eye on. Okay, so just letting you know that one. It's actually coming back to your way. Yeah, I think in general, just talking in general, as Ryan was already saying, and I guess Ryan is kind of in agreement with me. The bulk of the move may have been done, right, Ryan? That's my opinion. And this is probably, if it goes, your push to, I wouldn't say extremes, because anything can happen in the market. But this is your last probably push. This is how I look at it as well. I was okay with the outperformance of the sterling for a while, but how much further has it got to go? I'm not 100% sure, to be honest. And then I was talking about EuroCAD. This is what I'm keeping an eye on here. Going into that Canadian, the Bank of Canada this afternoon. Look at what's happening here. 146, 145.90. That's your support zone. Okay, 50% of the whole leg higher, October, November, and now we have actually, despite oils being lower, this is euro weakness. We've actually come down quite a bit, but I'm not going to assume that euro has done, oil has done dropping, or energy is done dropping. But depending on the report, if I'm saying, like, if we get it anywhere close to here, just looking at how weak the euro is, but how I also not really want to keep euro dollar for that much longer. Perhaps this is another one where a euro short could be in play. That is, if you get a mildly dovish, not like an uber dovish, which I don't think is on the cards anyway. But if we get anywhere into this 147.20, 147.5 zone, this could be one where try to counter trade a little bit and then look for a move lower. Last one, gold. We've held just above. We've held just above this this support zone. Didn't really tag it, but this is to me a decent support zone. Anywhere 2002, 2002, 2007 should be a bit of a support. If you take this big jump, but we will never know where the real high was. We can see some support now around 2015 as well. I bought just a tiny nugget. I'm shame that I didn't leave my order firm in at 2010, or I would have been filled. But if you look at this little move that we had overnight, which we have completely undone, by the way, it looks as to me that perhaps China is still quite interested in buying a bit of gold. So keep a very close eye. I will on what's happening here in this. Let's call it 2010 zone on gold. If it breaks through 2000, then we can see a bit of a deeper setback, 1980 perhaps. But I'm going to keep a close eye on what's happening around there. I am just on gold, Deregi. On the top side, we need to start holding. So we had this spike above 2030s, which didn't hold this time. We need to start holding this 2032 and then break above 2040s to start moving higher again. And then I'm talking about 2070s. I'm not talking about 2050 will be a level as well, but I'm not talking about going back to those highs right here and now. Still think this is a foolish move, but to get back to those levels, we are going to need to hold 2030, which is not doing right now, and then successively 2040 and 2050. Okay, these are your top end levels. And with that, back over to you, Ryan.
Thank you very much, mate. Thanks for all that valuable insight there. That's us done for today. Keep an eye on those ADP numbers. 130k expected. So if it's a big outlier, that's going to get everyone jumping around for the ADP. And don't forget our NFP competition, already in the chat link there. Thank you very much, everybody. Have a great day, everyone, and we shall see you all tomorrow. Have a good one.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.